Hey everyone, in this video, we're just going to do a portfolio update. I'm going to take you through my entire $160,000 Wealthsimple portfolio. In this portfolio, I have both US stocks and Canadian stocks. So I'll go Canadian first and then US. If you just want to stay for the US part, you can see it in the bottom on the timestamp. First of all, before getting into this, if you like this type of content, be sure to subscribe to my channel, like this video. It really does help out with the YouTube algorithm. But other than that, we will just jump right into it. So overall in my portfolio, I'm up about $20,000 overall across my two accounts. About 12,000 in my Canadian account, and then after FX, up about $8,000 in my USD account. Most of my money right now is in my Canadian account. You can kind of see its growth over time from late 2020, and then currently I've put in about $125,000 or $127,000, and I'm up to about $140,000 in net value in my account so far. So going stock by stock here, first stock, I got Allied Properties. It is an okay size position, about 2.8%. This is a office REIT for the most part. They have lots of their assets in Ontario and other major cities in Canada. This one makes just over $2, about $2.20 a share in funds from operation. So it's trading now at about 10 times earnings. A year ago, it was making the same amount, but trading closer to 20 times earnings. So it's been huge multiple compressions on office space, given kind of the delay of return to office and interest rates and everything else has just been a huge storm for this asset class. But honestly, at 10 times earnings, paying almost an 8% dividend, this is a stock that, sorry, I got something in my throat, that I don't mind holding here. Moving on a bit to other holdings in my portfolio. A&W Royalty. This is a royalty corp. You get paid about 4%, I believe, of all sales at A&W restaurants across Canada. It's held up decently over time. This is one that I get 5%, 5.5% dividend. It gets paid monthly. It's a stock that I'll probably look to add to in my portfolio, even though it's a decent sized position here. About 10% of my Wealthsimple portfolio, but I don't own this anywhere else. So in the grand scheme of things, it's not a overly huge position for me, but I really do like getting that monthly income, and they have increased their dividend over time. Bank of Nova Scotia makes about $7 to $8 in earnings per share. So it's trading at about 8 to 9 times earnings, getting a nice 6.2% dividend yield. Also gives me some exposure to Latin America and the Latin American market, since they have bank branches down there. So at an under 10 PE with over a 6% dividend yield, this is one that I'm actually adding to right now as well. I'm going to skip through some of these a bit more. CAPREIT is an apartment REIT in Canada. That's a REIT that has done really well over time. It slipped up here lately with interest rates going up and the broader REIT segment, but it's a stock that I plan to hold for the long term. Cash is essentially just a company or an ETF I hold that pays me 5% annually in monthly distributions to hold cash. You get a good sense if I show you the 5-year in terms of the type of asset class it is. It just goes between $5 and $5.20 a share pretty much, then pays me out the 20 cents a share and goes back down to $50. I said 5, but I meant 50. So I have about $17,000 in that one there. If it was a great opportunity or the market was crashing, I'd probably take some of this out, start putting it into equities. CN Rail is one of my favorite stocks that I own. They buy back shares every quarter. They increase their dividend every year. They have a huge moat. So that's one I have 70 shares of in this account. Canadian Utilities has increased their dividend for 50 straight years, even though it's usually just about 1% a year nowadays. This one's really rallied lately over the last month, up 2%, over the last 3 months, up 7.5%. That's in addition to the 4.5% dividend that they offer on an annual basis. Diversified Royalty Corp. This is one that I've built into a bigger position over time. I'm kind of holding on it right now but they own the trademark rights to businesses like Mr. Lube, Oxford Learning Centers, Sudden Realty Group, and just get royalty payments in and then send them out as dividends on a monthly basis. They're yielding right now about, just over an 8% yield. So pretty good yield on this guy. It pays out monthly, but very volatile with the broader economy and how much money they're able to bring in. First Capital, it's a retail REIT. Their net asset value is about $24 a share, so trading at a huge discount. So I think, while I want to fine-tune the amount of retail REITs I have in my portfolio, they pay a good dividend, they're trading at a discount, so that's why I own this stock. Fortis, similar to Canadian Utilities, is a utility company for the most part. They pay a pretty decent starting yield, close to 4%, and they increase it about 5% every year. So it's a bit of a dividend growth stock, highly regulated utilities. So I like having that one in the portfolio. You can see over here, it's done pretty well for me over the last year or two. The next two stocks here are covered call ETFs. So HDIF is a combination of all of Harvest's ETFs. And then they also layer in about 25% leverage. So it's a bit interest rate sensitive as well. With that being said, they do pay about a 10% dividend, give or take. So you're getting a lot in yield, even though you're exposing yourself to, the risks of covered calls, being if stocks go up a lot, you're not capturing all of it. And in addition to that, in addition to selling the upside, you're also leveraged. So if interest rates go up, that can be an issue as well. Huddle is an individual Harvest covered call ETF, specifically surrounding utilities. So it's a global utilities fund. In Canada, think like pipelines, telecommunication companies, etc. But they really have exposure globally in Europe, in the US, etc. So you're getting those types of businesses on a global scale with hyper income focused asset through covered calls. So paying almost 8%. This one's actually been about flat, up 2% for me on top of that 8% dividend that I've been getting. So doing decently on that investment. Continuing to go down, similar to A&W, Keg Royalty, you get a royalty payment monthly on every dollar that's spent at Keg restaurants. Labrador Iron Ore, this is a new investment I made, just 15 shares, so I'm averaging into this one. But it's essentially a royalty company, no debt on their balance sheet. You just get a royalty for every ton of iron ore that comes out of this joint venture. Life is another covered call ETF, similar to Huddle, but it's focused on healthcare stocks. So think Pfizer, all big pharma companies essentially, like AbbVie and stuff like that. Just with a covered call written on them. So this one's paying me a good dividend yield too, 8.7%. So really income focused on these covered call ETFs. They give me, a lot more income in my portfolio every month of buying more and more stocks. Northwest Healthcare Properties. This one slipped a lot over the last couple of years. They've had some struggles. Let's look at it in the past 1 year, down almost 40%. Currently paying a 10% distribution. I listened to their earnings call. They're expected to make about 80 cents of funds from operation this year. They have a mid-term target to make $1 a share in funds from operation. So trading at a treat valuation. But they are getting into lots of like management of hospitals and other things that I didn't initially care for when I bought the company, and they're kind of moving in that direction, which is a lot more volatile than just inflation-based rent payments. They also have a lot of leverage, so that's really hampered the stock as interest rates have gone up. But the good thing is they have primarily government tenants in their hospitals. They're really global in nature, so they have access to cheaper debt markets. And this is one, while maybe a bit on the riskier side, given their payout is 100% or more of their funds from operation, I think the asset overall will do well long-term. QSR, so Restaurant Brands International, is a stock that's performed really well for me, up over 30% in this portfolio. In the last year alone, the stock's almost up 50%, which is crazy for the type of business it is. They essentially own Burger King, Popeyes, Tim Hortons branches in Canada, and then Firehouse Subs. Most of those stores are franchised, so they're just getting a royalty on a monthly basis for the use of their trademark. But this is a business that's been going up really well lately behind hiring Domino's ex CEO is the chairman. He did a great job on Domino's, so people think he's going to bring that to this business. In addition to some really good signs that Burger King is getting turned around around the world, really strong same-store sales growth on that brand that's really been struggling for a number of years. So that's really turned the tide in the story on Restaurant Brands International here. They trade about 23 times earnings, pay a 3% dividend. So if you don't like McDonald's stock or McDonald's as a business, this is a great alternative in the quick service restaurant space, ticker QSR. All right, getting to the down stretch here. RioCan is similar to First Capital. It's a retail REIT in Canada. They're making about $1.80 funds from operation a year, so trading at about 11.5 times earnings, pay about a 5% dividend yield, have a big development pipeline. So I like this stock. Once again, just have to be careful with how much money across my portfolio I'm putting into REITs and retail. But I love the distributions. I get paid monthly. I like how they're trading under their net asset value. And it's one that I'll continue to hold. TD is one of my top positions. It's crashed a bit given the broader banking crisis in the U.S. They do own a percentage of Charles Schwab. They also have a pending acquisition of First Horizon in the U.S., and that's really dropped the stock given their U.S. exposure, given like the let's call it the banking crisis that's happened. It's mostly rebounded, but over the last 3 months, down still 12%. I've used it as an opportunity to buy more across my accounts. Probably just bought 5 or 10 more shares in this account. But I think long term, TD trading at a 4.5% dividend, under 10 times earnings per share, will treat you really well in terms of long term yield on cost and returns. Then I have my 3 ETFs down here. ZDI is an international the ETF, primarily holds European blue chip dividend paying stocks, also some Japanese stocks as well. So I like this one for diversification, have about $10,000 in this account. ZWB is a covered call ETF on Canadian banks. As Canadian banks have gone down, you can kind of see this ETF has not done that well, but I do get about a 7-8% dividend yield from it. And then ZWC. ZWC is a high dividend covered call ETF on the entire Canadian dividend market. See, last year down about 7%, but I've gotten that back in yield, so it's about flat overall. So this is one, once again, that is just a good way to get enhanced monthly income, but not necessarily going to deliver capital appreciation over the long term. So I know I ran through that pretty quick. If you have any questions about any of these stocks or any comments, would love to hear from you in the comments. But overall, this portfolio is up about 9% for me. Lots of that's coming from the dividends that I've achieved from these ETFs and these dividend-paying stocks. Some of it is through capital appreciation. Overall, it's been doing okay over the last 1 to 2 years, so happy with the performance here. Moving on to the U.S. portfolio. So my U.S. portfolio is up over $40,000 about 18% up, and that is only over the last year and a half or so when I got this USD account. So it's been performing really well in the last year, up 21% in the last year. So going through some of my positions here, Google's just been on a tear lately. Let's just go in the past 3 months, up 25%, which is huge for a $1 trillion company. You know, there's lots of back and forth on how they're going to integrate AI into search and other things. I think that Google will be just fine over time. Like, I'm sure they've been working on this for years and years, so they're just commercializing it. Maybe some bumps around, bringing it out to the market, but I think they'll be fine. They have a cash cow business on search. I just hope that they can diversify their business on other business segments. Their cloud business is starting to show real promise on gross margin improvements sequentially quarter after quarter. So we'll keep an eye on that one. But overall, this one's not going anywhere. Coca-Cola is one that I recently added in my portfolio. I love the annual dividend increases. I like the starting yield. Unfortunately, since I added it, it just keeps going up. So I'm up over 7% on this guy. So, I'd love to build this into 100, 200 shares, but would love to do it at a lower price, under $60 at least. So kind of just waiting and seeing if this one's going to keep going up. Maybe I just sell it and take my 10-15% gain and wait for it to go down in the future. But would love to build this into a real position. Just want to get a better value on it. Next, McDonald's. McDonald's has been a core position for me across many accounts for a while. I don't have a ton of it in here, just 7 shares. And part of the reason is because it just keeps going up. So the stock's trading almost 30 times earnings, really hard to swallow. But I'm going to keep holding it. I'll get my 2% dividend. Hopefully it can grow into that valuation, or the stock price will come down and I'll buy more of it. But it is a small position for me here in this account. Meta has gone up more than any stock I own in this account, up over 120%. Now, before giving me congrats on that, I've been holding Meta for years and years in other accounts. So overall, it's been a wild ride for me over the last 5 years. Holding over 300. I think I bought more around 250, then going all the way down to $90, and now on my way back up. So it looks good on this tranche that I bought of 11 shares, up over 1,400 US bucks. But overall, it's been very mediocre. Topgolf Callaway, this is a stock I just bought this week as well, 25 shares. It's gone down a lot after their earnings last week, down 23% on the week. Thought it was a good opportunity to start nibbling in. If it keeps going down, would love to build this one into a big position. I think Topgolf has a lot of return on invested capital opportunities down the road. Their golf ball and apparel businesses are cash cows. So they're investing a lot in CapEx to build out Topgolf, but I think when it's all said and done, this will be a very profitable company at the right price. So if it keeps going down, I'll build it into a position similar to Coca-Cola. If it just trends up, maybe I'll just dump it, take a small gain. But yeah, added this one very recently. Microsoft, love lots of their businesses. They've run up the last month or so, let's call it, up 8% in the last month, up 14% in the last 2 months. I remember I was buying this one at $220 a share, which didn't seem like that long ago. So haven't been buying any more now, but I have a decent sized position in this account, 27 shares. Realty Income, relatively new portfolio. It's been trading around $60, so I actually just added to it this week again, hoping to get somewhere between 1 and 200 shares on this one by the end of the summer. Love getting that monthly dividend yield, close to 5%. Trades at about 15 to 16 times funds from operation. So once again, being careful on my total REIT exposure, but as I grow the overall portfolio, I don't mind holding my weighting of REITs overall, and that's one of the ones I'm putting more capital into to make sure that happens. P&G, similar philosophy to not Coca-Cola, to McDonald's. It's been a part of my portfolio for a while. Only 17 shares in this one. I hold it in other places. Up 16%. Love getting that dividend. Love the dividend increase every year, but pretty heavily valued, so not adding to it. So AT&T, this company I have added to recently. I have down on every share I've bought in, pretty much down 17% in this account. Stock trades at $120 billion, and they are free cash flow positive by about $16 billion. So they're trading about 8 times free cash flow. They're paying a 6% dividend, so they can cover that, pay down some debt, reinvest in their business. So I just like the valuation on this one more so than the business as a total. And it's one that I'm going to be careful in. I'm going to keep looking at the quarterly reports, but I wouldn't mind owning a tiny bit more of it, continuing to buy in, get that 6% yield, and go along for the journey a bit. But yeah, definitely not looking to make this like a huge position. Visa is one of my favorite companies. It ran up earlier this year, so I was buying it around 200. Unfortunately, now at 230, so I couldn't buy it as heavily as I wanted throughout the year. But I do really like this stock. Trades at a bit of a premium, but I think it's worth it for the type of business model, the moat, how profitable this business is, and the value they bring to consumers and merchants, even though there's lots of disagreements on that. This is one, if it slips down below 20, would love to start allocating more and more capital to it. They've about cut their share count in half over the last 10 to 15 years. They've increased the dividend double digits every year. So just a great stock, great business at a high valuation, but they deserve it, in my opinion. And last but not least, before I lose my voice, Wyndham Hotel and Resorts. This is one that's been on my watch list for like about a year. I just bought into it yesterday or 2 days ago. I have 3 shares, so I barely have anything in it. As it goes down, looking to buy more. This company is going to make about $4 of earnings per share this year. So this is it trading at about 16 times earnings, and they're looking to grow 5 to 10% next year. So next year it'll be about 14, 15 times earnings. If I can get this one at $60 or lower, I'll make it into a much bigger position. Looking to nibble on this one, 5 shares here, 5 shares there for a while until I get to hopefully about 100. But this is one that I love their business. Once again, as you can tell from some of the Canadian stocks I own, this company has a royalty model. They don't actually own any of the hotels. They just get a royalty on every night stay that people go and spend money at the hotels that are owned by their franchisees. They're expanding globally really nicely. I'll have another video out about Wyndham. I actually did about a 40-minute video on Wyndham back in the day if you want to search on my channel a couple months ago. But this is one that would love to own the business long term as long as the valuation's right. So thank you guys for bearing through all that with me. My overall portfolio, I think, has been doing pretty well. It's primarily a dividend income portfolio. Don't really buy and sell my core positions too much. I only do that when I'm trying to build up a position. If it gets to a point that I don't want to buy at the current valuation, I'll just take a gain. Other than that, really focused on building out positions for the long road, cashing in those monthly dividends, using that to fuel further and further portfolio growth, and then hopefully one day using that to live off of and help my income and lifestyle. So that's a bit more about me, a bit more about my portfolio. Thank you guys so much for watching the video if you saw it all the way through. Would love to hear your comments on any of my positions or stocks in the comments, and I'll see you guys in the next one.